Welcome everyone, and this is for the last July to September quarter, and I appreciate Clint Abraham, who's on our webinar at this moment, who's going to, Clint Abraham is from Morningstar. He's a portfolio specialist there, which basically means he sits on the committee that makes the decisions around the portfolios and how they're invested, and we appreciate his time today. But we've asked Clint on because, well, in the last quarter, there's some amazing, we're coming out of COVID, we're coming out of, we're going into a recession, and going into the next quarter, we've got the US elections, we've got the Brexit decision, so there's a lot happening, and I just thought, get the person himself. I'm sure you'd all like to hear from him. But before I introduce Clint, I do need to let you know there is a general advice warning that anything that's said today is of general advice and shouldn't be acted on unless you get specific advice tailored to your own situation. Well, Clint, welcome, and thank you for your time today. I suppose I'll start off, if you wouldn't mind, asking you your first question is just a quick summary of what the markets here and overseas have been for the last quarter. What's your view on that?
Sure. Thanks, Mark. Thank you for having me along. And it's certainly been a fascinating 2020. So while the first quarter of 2020 obviously saw significant losses in share markets, given that was the start of the COVID uncertainty, the second quarter saw a very significant rebound. And really the third quarter saw a continuation of that rebound, even though overall returns were much more muted than what we saw in the second quarter. So generally speaking, share markets went higher in local currency terms. And interestingly, year to date, it actually looks, for ease of numbers, around flat returns, which I think you'll agree is quite extraordinary given the roller coaster that we've been on throughout that period. I think the real key, though, is that while it looks like share markets in aggregate have returned to around that flat level that I touched on over the course of 2020, what we're seeing is significant divergence when you dig a little bit deeper. So, for example, the US share market has done very well, particularly buoyed by positive sentiment towards some of the popular US IT companies, whereas other countries like the UK are actually struggling at the moment. They're already dealing with Brexit uncertainty before COVID obviously affected that country very badly. So this is very consistent, even at a sector level, as I touched on IT doing very well. Other sectors that are more sensitive to the outlook for the economic environment, like energy, for instance, they are struggling year to date. Okay, so
what we've all been, I suppose, waiting for is to see when that rebound. No, we can't ever pick the timing of the market, but what do you see? Is it a vaccine that we're all waiting on, the magic vaccine, or is it waiting for you mentioned before about the election coming, or getting through this recession, low rates? That's too simplistic. What's your view on, especially about a vaccine?
Yeah, I think you've highlighted it there. There's a number of different factors that are at play at the moment. And in actual fact, it's quite a complex situation. So obviously a vaccine would be very good for sentiment. It would give us presumably some confidence that we're going to be able to return to whatever normal looks like for us moving forward. But the outlook for a vaccine is still very uncertain. We're not even sure if we're going to get one, let alone what the timing for that will be. And as you touched on, there are a number of other drivers in the market at the moment. We do have the presidential election coming up, Brexit, of course, trade wars are ebbing and flowing from our news flow from time to time. So in actual fact, there's a lot of things going on at the moment. What's the catalyst for here? Well, as I touched on, we think that share markets, particularly in the US, have done very, very, very well. So investors are using, we think, low interest rates as a way to justify high current share prices in the US. And in actual fact, we think that they might be extrapolating forward, what has been a very good period for some of those US IT names, as reasonable expectations of how those companies may deliver earnings in the future. And that for us, raises some concerns. Obviously, it remains a very uncertain environment, particularly with regard to COVID. We appear to be in a second wave amongst some key economies right at the moment. And we think there's very little room for error in certain share markets.
Okay, so just off the back of that, and I will come back to asking you about what you do think about the US election or possible
Sure.
repercussions, but really since the drop in March, so we'll say roughly numbers, was at 7,200, dropped down to about 4,800, and now is back up to around the 6,000, 6,300, just keeps bouncing 1 week up, 1 week down.
Yes.
But that big comeback from 4,800 up to 6,000, what was so unusual about it was it seemed to be off the back of mum and dad investors. When you looked at the institutions like yourself or other major companies, they weren't going back and buying heavily. Maybe you're buying selectively. So is there still a concern from the institutions that really the share price isn't really a true reflection of what it should be, or where you do see the numbers at the moment?
Yeah, I think that's a good question because, as I said, there is a lot of uncertainty. And to your point, I know you were quoting figures there for the Australian market, but that broad sort of thematic was very present in many markets around the world. And so, we had that was the fastest bear market in the US that we've ever had. And it was also the shortest bear market in the US that we've ever had at only 33 days. So that is a very, very sharp bounce, drop off and then bounce back, a bit like hitting the trampoline, if I could use that analogy. And that's very indicative of what COVID represents, a significant external shock that people didn't really see coming. And while I guess the shock of COVID in an investment sense may have worn off, what we have to do as investment managers is look at what's currently being priced into markets. And certainly for the US, which I touched on before, to a lesser extent Australia, we think that there's now very little room for error in some of these markets if we see, prolonged second wave of infection, if people aren't able to go back to work in the way that they otherwise may have been previously employed. Some of these lockdown trends prove a bit more enduring, and if nothing else, the economy is not able to bounce back the way that many are forecasting. So we can still see opportunities in global share markets and even in the Australian market. But there is a balance there where you need to be really clear on what the potential reward versus the potential risk is.
Okay, thanks for that. So yeah, I may as well ask, because you've mentioned the US a few times. Is there sort of a Morningstar view on a Biden or a Trump win? How they would, the repercussions of potentially of that?
Yes, I think the way that we would approach this is not so much by trying to predict the outcome of the election, because that's actually very difficult to do. And you just need to look back at the previous election to see how Trump got up, despite what the polls were telling you, despite what bookmakers were telling you. And the way that we might approach that is by trying to understand, what some of their policies are going to look like and potentially how they may impact the cash flows that we're looking to receive as investors. And of course, there's still, much more detail to come out around those particular policies. So while it appears like there's a Biden victory on the way, again, we won't know until obviously that we actually get to that point. And even if we did make a call around Biden or Trump, that in itself doesn't necessarily lead to an investment decision. Again, if you think back to 2016 when Trump was elected unexpectedly, it actually proved a very good time for investors immediately following that, which again might be a bit counterintuitive to what you might expect, given, I guess, the uncertainty around his campaign at that time. So, I mean, I think it's pretty safe to say you're going to see a continuation of supportive monetary policy, stimulus. Obviously, each party will go about that a little bit differently. But I guess, time will tell what ultimately the shareholder reaction is going to be once that election is known.
And what about Europe with the Brexit decision like December or something?
Yes, we're certainly getting to the pointy end after what feels like a very long road. And again, there's a number of things there that are still yet to be resolved. And generally speaking, they're really hard to predict. And again, they don't also lead you to an investment decision. But I think if we look at the UK share market in particular, and I touched on this a little bit earlier, where the UK share market is still down significantly, around 20% year to date. So while the US has seen the rally back, US has rallied back, the UK hasn't. And again, partly to do with Brexit, partly to do with COVID, I imagine. But what we know is that when we look at the UK share market, something like 3/4 of its revenues are coming offshore. So the market itself is not a direct reflection of the UK economy. And obviously Brexit's going to very significantly affect the UK economy, even though we don't know what all the finer details look like yet. So with these various sort of macroeconomic, political type issues, we're the first to say that they are hugely important, but they cannot be predicted with great accuracy. But again, the guiding way that we would try and approach these types of scenarios is by understanding whether we're getting a good deal to invest in those markets, whether you're getting compensation for some of the risks on the horizon, or whether they are priced much closer to perfection.
Yeah, thank you for that. I suppose, therefore, the way you're speaking about how the Morningstar approach is. So, and I know that you're looking at your portfolios as we look at regularly, that for a lot of portfolios, there's still a fair amount left in cash at the moment.
Yes.
So is it still therefore the overall view of Morningstar that, yes, it is still volatile. We haven't hit the recovery yet, and that this could be another 3-6 months the way it's going at the moment?
I think that's a reasonable summary. Certainly, there's some pretty big headlines out there at the moment, and obviously, as we move through the remainder of this year, we're going to get clarity around things like which president we're going to have in the US, and we'll have a greater understanding of what Brexit's going to look like and so forth. But by the same token, we may or may not have much more visibility around what the ultimate path for COVID is going to look like, both in a health sense and also what it might mean for the economy. So there's still going to be a whole range of uncertainty out there. From an investment point of view, though, I should say that when we saw those falls in March, that's the best range of opportunities that we've seen in quite some time. And that's very consistent with investors getting overly pessimistic on the outlook for the world and for individual companies and sectors. And what I would say is that even though we've seen a significant rally back over those ensuing, what would that be, sort of 6 months, we can still see some real opportunities where we are getting very, very attractively compensated. So it's a bit of a balance. It's investing in those opportunities. And I touched on countries like the UK a little bit earlier, where we think those expected returns from that market are genuinely ahead of what we might otherwise reasonably expect. So we would say that they are cheap. We're getting a great deal in that market. We can also look at some individual sectors like energy, where there are concerns around global growth, but the shareholder reaction in that sector, we think, has been very pessimistic. And again, it's creating that opportunity for us as valuation driven investors that like to hold assets or are focused on delivering returns over the longer term. But then on the other side, we can go, okay, well, we're seeing some value here, but we also need to hold a bit more cash because it's not widespread value, it's very targeted. And if we're right, then you might see further volatility come up in the future, and we'll be very much ready to buy those assets that it makes sense to do so at that time.
Excellent. And thanks for that, Clint. And probably just to finish off, it's for me the reason, especially the main reasons I do like the Morningstar philosophy is that in a main it does have the diversity of international markets against a lot of other funds. Traditional funds have a domestic bias to Australian shares,
Yes.
and that having that, and you are basically the world's research house, everyone before the Morningstar. So yeah, you see anything else that changes at your mind that, having a diverse international focus than just being mainly focused on the Australian markets is going to be beneficial to our clients?
Well, obviously the international markets are enormous, and Australia is only something like 2% of the global market cap. The point I would extend there is that obviously when we talk about international markets, typically people initially default to the US because it makes up roughly around about 58% of global markets. But on our analysis, that particular market is not that attractive. We can see a low expected return, a much greater risk of loss. And so that actually points us towards some different international markets. And I did touch on the UK. You'd be familiar with our positive view on Japan, certain emerging markets as well, and to a lesser extent Europe. So we can see much better opportunity in some of those markets versus where money might typically go for an Australian investor, which is towards the biggest international companies. So I think that countries, and that's, I think, really the key. We're in this environment where we need to be prepared to be a little bit different, where we are getting a good deal, maybe not where we might have previously got a good deal. And so from our point of view, when we're building our portfolio to where we are trying to achieve the most attractive reward for the risk of investing, obviously we want to be pointed towards those sort of assets rather than those that we think are overvalued.
Clint, that's been brilliant. Thank you very much for your time. Yeah, just to give us an update on the last quarter and potential next quarter. Probably the next time we do another something like this in January or something like that, it could be a very different looking world. So
absolutely.
Okay, Clint,
thanks for having me along.
Very much on behalf of my clients and myself. I appreciate that update.
Thank you for having me.